That was a pretty big day for stocks as we've been monitoring a range underneath the all-time highs for the S&P. It's basically been a couple hundred points that we've been floating around in for the last couple weeks, and today it looked like bears gained a pretty significant edge, especially when you pair it with the fade from early strength to start the week on Monday. You could look at this a couple ways. You could look at it as this post-election euphoria that probably was getting too speculative, a lot of measurements for valuations, Bitcoin at 100,000 plus, all that stuff that suggests we needed to let some air come out of a bit of a bubble. The other framing is that big tech specifically, which got hit harder today, is catching down to weakness that had already shown up through the deterioration of small caps, value trades, and the last 4 weeks basically of weakness, which was the cause for the yellow light on my stock trade. Now, for the range in the S&P, we've held it. So everything holds here for now. I was wondering whether or not the bond market would respond the way I thought to data. I'll get there in a second. Basically, it did. The bond story and the dollar story is another explanation for today. But let's just go firstly with the price action and the technicals. If you're thinking about it from a big tech perspective, you don't have to panic yet. We literally put in highs for NVIDIA yesterday. And you combine that with volatility at just shy of 18. There's nothing terribly alarming on this chart. Here's a look at the MAGS ETF. This is not a terribly concerning chart pattern right now. Yeah, you can make lower highs, lower lows, and start to say it's the beginning of a downtrend. And that wouldn't be good, of course. But you're less than 6% down off the highs. For volatility for VIX, it's creeping up, yes, and you can kind of see this little turn up a bit. But the point is that the perspective you have to carry right now is that unless there's a sort of an outside force, then this is a natural kind of corrective action for an inflated valuation market. So that's where the bond and the dollar story comes in, because this is where the analysis have been focused on since I took the green light off bonds in September last year and put the red light on in mid-December to show that the potential for yields climbing is really the main macro story right now. That to me has been validated. Now we're trying to test the highs for the yield. The dollar had already broken out, so a lot of these pieces are fitting together the way we've talked about here on Risk Radar. And to see that extend does tell me that this is probably getting to a point where it is pressuring stocks. There's no mistaking that today when the prices paid came in hot, the market changed around pretty clearly. The services number for prices paid and ISM, that was a doozy. That was some serious heat. Jolts back to 8 million was the highest level of job openings since the spring. These are good things. These are overall good problems to have, if you want to call them problems. But if the stock market can't handle that, then that's telling us we're likely going back into a scenario where good data is bad. Inflation's maybe a problem. And as we recall in 2022, that's the version of the nastiest bear market that we've really seen outside of exogenous events like COVID. So this is a big deal. The fact that the dollar has presaged this move in the 10-year, and the fact that now if you've opened up moves to the upside for both, you could be going back to levels we haven't seen in a while. And that kind of gets the ball rolling again about back to the policy side. How much issue are we going to have keeping inflation down when the whole conversation about Trump 2.0 has been growth-oriented, and the fact that the markets and Bitcoin prices are going to make everybody rich, all this stuff? This narrative is breaking down. So if the technicals break down for the S&P, that red light is going to go there fast. And that's pretty simple. As KG and I've been talking about, the range 5850 being the low that he's been pointing out, I think that's pretty spot on, right? I mean, this chart kind of reads itself to a certain extent. Here's the gap from the election. We're trying to hold that level. This today obviously gives bears an edge because now we're moving back down there instead of away from it. But the yellow light's still there until we really break that. If that breaks, because we're getting chaos in the bond market, if data come in too hot, that to me is going to be a bad situation. That's going to further expedite the air coming out of that post-election bubble, which if we break down, the technical door opens up pretty wide to the downside. The red light on crypto still holds. No question that that is still the higher risk asset as it got hit today harder than stocks. Have a good night.